In the last financial year, the IT services sector brought in an export revenue of $181 billion, and the revenue it clocked comes to about 8% of our country's GDP. In the stock markets, the IT sector has 11% of total market capitalization, a number which is probably 11, maybe 10.5% more than where it was 30 years ago when the Nifty was first launched. Point blank, the Indian tech industry is important for India and for the world, and given the wealth some of these companies have generated, it's something that investors like you and me should not and cannot ignore. And so in this video, I shall take you through my understanding of the IT services sector and the key parameters one should look for when evaluating companies like TCS, Infosys, Wipro, etc. Let's begin. Indian IT service companies compete on a global scale. Their competitors include some really well-known names like IBM, TCS Technology, which was earlier Computer Sciences Corporation, Accenture, Capgemini, Atos, Fujitsu, etc. In the last 2 decades, while the Indian IT companies gained significant market share, every other global player lost a few points, with Accenture being the only exception. In numbers and since 2010, the revenue market share of our top 5 companies have grown from 9% to 25%, and pleasantly, even more companies are on the verge of entering the billion-dollar club. Now, I believe this rift between Indian and global tech companies is only going to widen from here, as India offers some unique value propositions which include high levels of agility in responding to disruptions, and digital services is a good example of that, having grown from nothing a few years back to 30-35% of our IT export revenue. India is also a talent hub with over 6 million software developers, which is more than the population of Singapore or New Zealand. India is a low-cost center as compared to the US or Europe. We have an innovation ecosystem with over 27,000 active tech startups that are creating niche solutions. And finally, there is the infrastructure, and Indian companies have over 1,250 global capability centers in India and 780 offshore development centers globally. Now, FY22 was an important year as industry revenues grew by 15.5%, the highest growth rate in a decade, to reach a revenue of $227 billion. As expected, the bulk of these revenues were exports, $178 billion, with about 55% of that coming from the US and Canada, followed by the UK and then the rest of Europe. Of course, this means if the US sneezes, then some of that virus, metaphorically speaking, will also fall on the Indian tech industry, which means the growth of our IT services industry is closely tied to the global conditions. Now, as a thumb rule, the demand for IT services in developed markets grows at 1.3 times the growth in GDP. And with the less developed and emerging markets growing faster and quickly adopting digital technologies, one can assume that the Indian IT services industry is likely to grow at 9 to 10% over the next decade. When we come to specific metrics, we'll see why this 9-10% estimate seems very realistic. But on a side note, I'd like to add that some of the bigger tech companies are doing an incredible job on the branding front and making themselves known to global audiences. In fact, sports is that chosen vehicle, and the TCS marathons in New York and London, Infosys at the Australian Open, HCL's association with Manchester United is all in the right direction, as name recognition not only builds an identity for the brand, but it also attracts the best talents in the business. The final subsection within this industry macro play are the risks, and the IT outsourcing sector has a fair share of its troubles, bugs as the industry calls it. The first is regulatory risk, and the availability of long and short-term visas have always been an uncertain and itchy problem. Now, over the years, there has been a gradual tightening in the issuance of visas, which the IT companies have moderated with more onshore hiring and subcontracting. It's not an ideal scenario as it increases costs and lowers the operating margin for these companies, but some balance between onshoring and offshoring should always be there. The second risk is, of course, competition, and what India did some 2-3 decades back. Well, there is always the possibility of an English-speaking, skilled, but low labor cost country or organization replicating that. I mean, yes, the Indian companies have global in-house centers, data controls, etc. But the risks are unknown when it comes to newer technologies like artificial intelligence, cloud computing, machine learning, automation, microservices, etc. In other words, it's important for our IT companies to continuously adapt to newer technologies to remain competitive and enjoy higher billing rates. And a third risk that is often cited is around foreign exchange. Now, Indian IT companies earn most of their revenues in dollars, euros, and pounds, and therefore the movement of the Indian rupee against these foreign currencies may have a positive or negative impact on the earnings. For example, an IT company might report that its revenue has gone up by 10% on an year-on-year basis. But what might have actually happened is that the Indian rupee might have depreciated by 10%, and what seems to be a growth in sales value is merely a non-operational benefit that the company has enjoyed. In that context, even the reverse can happen, which is why most companies use various derivative instruments like a forex forward, currency F&O contracts, etc. to lower the volatility in earnings caused by these foreign exchange movements. When it comes to the key metrics, the framework can be broken into three major clusters: the business, the operating efficiency, and thirdly, the valuations. Let's start with business, and it all begins with the size of the company. Now remember, IT service companies are there to help clients digitize and improve their processes and to do it at a cheaper cost. Now, if every task, every process was given to a different service company, then it can be an absolute nightmare in terms of organizing and integrating, which is why most clients prefer to work with a single big-sized IT company that can offer multiple solutions. And in case there are any special skills required, most large IT companies would find ways by either developing this new skill in-house or by training trained employees from outside, or as it happens often, they would simply buy out a smaller IT company that already has those skills. This is one reason why there are a lot of mergers and acquisitions in the sector, but it's this continued flexibility that allows big IT companies to win more business. Now, generally we classify IT companies as tier 1 or tier 2, and this is entirely a size thing. So tier 1 are the 5 biggies: TCS, Infosys, Wipro, HCL Technologies, and Mahindra. And in terms of sales, each of them clocked upwards of 50,000 crores last year. Tier 2 companies would include LTI-Mindtree, MPhasis, Coforge, which was earlier NIT Technologies, Persistent Systems, L&T Technology, etc. Now, because the tier 1 companies are already so big, their sales growth is a lot more sedate as compared to the tier 2 folks. But having said this, it's the tier 1 companies that command a higher pricing, which is reflected in better operating margins, and that's a product of the depth in service that they have and the economies of scale they enjoy. Now, there are two types of contracts in the IT services business. The first one is a time and material contract, which is an input-based model, and the client is charged on the number of employees and the amount of time taken to complete a project. Understandably, this is a cost-plus model, which means there is very little chance of the company making a loss here. The other type of contract is a fixed price model, where the client assigns a value to the project, and it is the IT company's responsibility and headache to figure out how many employees and the quality of employees it wants to put in to complete the work for the client's satisfaction. Now, the good part about a fixed price contract is that it gives the IT company a lot more flexibility, and it can manage its resources better to make the maximum profit from a contract. Of course, there is a flip side to all this, and if the company isn't able to complete the work on time or does a bad job of it, then the customer might not pay for the work done and the IT company would have to bear that loss. To put it differently, the time and material model is a low risk, low profit contract for IT companies, while a fixed price model, although slightly risky, does offer a higher scope for profit. And this is probably why most IT companies have been increasing its share of fixed price projects over the years, and it today averages around 65% for the tier 1 companies. Another benefit of these FPP contracts, and thanks to a lot more digital automation technologies, is that the IT company's revenue growth is not tightly dependent on the employee growth, and they can make a lot more money on the value they provide. So as investors, the split between T&M and FPP is something to look out for, and as a general rule, companies with a larger share of fixed price contracts are likely to have better operating margins. The third major metric is to track the number of clients, both in terms of acquisition and retention. Now, obviously, higher the number of active clients, the better it is. But what's also important is to examine the inflow, that is the number of new clients being acquired on a quarterly basis, and also the total contract value, or TCV as it's commonly known. Now, most companies report acquisitions on a 4-slab structure, that is the number of clients they've acquired in the $1 to $10 million band, the 10 to 50 band, the 50 to 100 million, and the 100 million plus band. Some of the bigger companies like Infosys and TCS also report in terms of how many of the Fortune 500 companies are a part of their roster, which not only gives them more stability in terms of revenue, but it also raises the global reputation of the company. The second part of the equation is retention, and usually a client would stick to an IT company for a decently long period of time, assuming the cost and quality is within acceptable range. But mind you, this industry is extremely competitive, and our IT folks have to compete at a global level with companies in the US, Philippines, China, Ukraine, Poland, Brazil, etc. There's an old saying that getting repeat orders from an existing client is a lot more cost effective than finding new ones, and the IT services sector is proof of that. So as investors, it's important to give a higher weightage to IT companies with a high volume of repeat revenues, as it shows the inherent strengths of their business model and offers them a competitive advantage over their peers. The fourth box, and a rather important one, is the diversification of revenue. So there are two ways to go about this. The first is geographical diversification, and in light of what we are seeing today in terms of geopolitics, economic uncertainty, protectionist policies, etc., it's desirable to have clients across countries rather than concentrating on a few regions. But as I have said before, a lot of the business presently comes from the United States and Europe. But as more countries and economies across Asia and South America grow, there'll be a lot more spread in these numbers. A second type of diversification is related to business verticals, and an assortment of industries ensures the IT company can easily survive a sectoral downturn. Now, the tier 1 companies are very active in the financial services, retail and communication space, with some offshoots in manufacturing and healthcare. In fact, the banking and financial services segment has been identified as a major growth driver by all tier 1 companies, as BFSI players continue to spend good money on cloud technologies, analytics, automation and cybersecurity. However, as we go down the list to the tier 2 companies and even specialist IT companies, we start seeing a lot more specialization, although it's not always the case. But KPIT Technologies is an apt example here, which does about 3,000 crores in annual sales, but does almost all of it from automotive technologies, making it a single business vertical company. So as a thumb rule, the more diversified a company is in terms of geography and business verticals, the more comfort it provides to an investor. When it comes to operational efficiency, believe it or not, the location of employees is an important evaluation factor. You see, in today's internet connected world, it's possible to do a lot of software work in India, and once it's done, it can be sent to a client in a foreign location in a matter of minutes. However, if a consumer in, say, the United States has to choose between two companies who are offering the same service at the same price, but one is doing it from India while the other is stationed in the US itself, then it's very likely that the customer would choose door number 2. And patriotism aside, with the client and developers in the same time zone, the coordination at work becomes a lot easier. A second reason why IT companies like to have employees in foreign offices is to improve their chances of winning orders and getting repeat business from existing customers. For example, Infosys has 196 offices outside of India and across 80 markets. Similarly, HCL Technologies is present in 52 countries, while Mahindra has a little over 200 offices in countries outside of India. Now, as investors, we should also appreciate the dilemma faced by IT companies, because the more employees you have abroad or on-site, as it's generally called, it also means an increase in cost, which has an impact on the bottom line. So there's a little balancing act involved here, and that's why it is important to get this on-site offshore mix absolutely right. The IT outsourcing business is labor intensive to the extent that manpower costs are about 50 to 55% of the total cost of operations. Now, a simple decision like how much annual raise should be given to an employee can be a very sensitive point, not just to the employees, but also to you as investors. Let's take an example here. So say an IT company operates at a profit margin of 20% and the employee costs are 50% of the revenues. The regular assumptions are around a 10% growth, that is a 10% increase in billing, a 10% hike in wages, and therefore a 10% improvement in profits. But if the manpower costs were to increase due to scarcity of talent or voluntary attrition, etc., and if this were to go up to say 20%, then what was originally a guidance of 10% growth would actually become a degrowth of 15%. So if you're an employee at an IT company, you'll be happy with that extra 10% in salary. But as an investor, I'm sure you'll be pretty upset with a drop in profits creating havoc with the stock price. The point is, an IT company's employee costs are the most important of all variables, and as investors, it's something we should track every quarter over a period of time. In the same thread, it's also important to understand a company's revenue and profit per employee. Now, I've examined the tier 1 IT companies, and to put it in numbers, an average employee earns about 7.2 lakhs in revenue for the company over a year and is paid about 3.6 lakhs on an average, which, as I said earlier, comes to 50%. On an individual company basis, these numbers can be a bit here and there, but as an investor, I'll be a lot more comfortable if revenue and profitability per employee is on the upward trend. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. Next up are the utilization levels, which is defined as that percentage of an employee's time that's spent on productive and billable work. You see, there will always be some employees in an IT company who aren't working on any project at a particular point of time. This can be due to many reasons like no new projects available, or maybe they are backups in case someone resigns, or maybe they are still in a learning mode, etc. The point is, this bench, as it's generally called, is a necessary evil, and ideally this is a number that should not be too high or too low. Now, generally a utilization rate of around 85% is considered good, but remember, this number is a bit variable. What I mean is, this number can go up and down depending on the number of engineering graduates, the inflow of projects, the type of technology, etc. But this is definitely one important number to track, because having a lot of non-productive, non-billable employees on your rolls and for a long period of time can mean a big visible dent in the company's profit and loss statement, which as an investor you don't want. And the last of our efficiency factors is the attrition rate, and the higher the rate, the more troublesome it is for the company. And that's because hiring and training a new employee involves a lot of cost, time and effort. And more importantly, an employee's sudden exit can affect project timelines and the quality of deliverables. In numbers, the 2021-22 period was really tough on HR managers, as they found it difficult to retain talent, and attrition levels were always over 15% and even 20% in many quarters. This has moderated a bit now, but it's still nowhere close to where it was or where the IT companies want it to be. So this concludes our 8 essential metrics that one needs to look out for when evaluating any IT company, and here's how our IT companies stack up in a single view. Understandably, I was unable to find every piece of information, but this table will give a fairly good idea of how strong each company is on a particular metric. And in a few weeks from now, I'll also do this exercise on a couple of IT companies so that we can have a better appreciation of the entire process. So watch out for that, and if you haven't subscribed to my channel, then kindly do so and don't miss out on investing videos that are released every week. Okay, now that we understand which business and operating metrics give inherent strength to IT companies, it's important to look at the financials, especially from a valuation standpoint. Honestly, I went through a dozen research reports and I could not find information that's as concrete as we had with the life insurance, cement or hotel industry. But from what I have gathered here so far, there were a couple of metrics the analysts were daily concerned with, that is the sales growth, which is a top line number, and the profit margins, which should be looked at on an operating level and also as a bottom line. Also, when examining IT service companies, the P ratio is something one should look out for, both on a historical basis and also relatively, that is, where is the company's PE as compared to the industry P ratio. Now, I purposefully said historical and relative basis because some companies have always been at a premium for very distinct reasons. For example, Wipro has mostly been at a discount to Infosys, and the lack of free float on its stock has something to do with it. Nevertheless, a careful analysis of the PE multiple can give big clues on which companies are overvalued and which ones are undervalued. A second metric that's often quoted in research reports is the growth in EPS, that is the earnings per share, and understandably, higher this growth, the better it is. Of course, this should not be viewed on a single year basis, and it's always ideal to examine it over a number of years and even compare it with how the industry itself has been growing. And finally, analysts often look at the ROE, the return on equity metric. If you recall, we often use the ROC, the return on capital employed, when evaluating manufacturing companies because there's often an element of debt in these companies. In that context, most IT companies have almost no debt, they have hordes of cash, and they are virtually a cash generating machine. Now, a good rule of thumb is to target an ROE that is equal to or just above the industry average. And if I were to put a number to it, then an ROE of 20% is the bare minimum one should be looking at when selecting an IT company. So look out for these three metrics, but put in a lot more focus on the business model, value proposition, the business and operating strengths when evaluating IT companies. To sum it up, it is my belief that Indian IT companies will continue to capture more market share for a few more years, and technologies around digital, cloud, analytics and AI will be the big drivers of growth, offering double-digit growth rates. So definitely watch out for this space, and don't forget to follow up on this sector video by reading up at least one annual report of a tier 1 or tier 2 company for a better understanding of industry terminologies. Once again, thank you for your time. Do like this video, subscribe to my channel, and I'll see you 3 days from now. Until then.